Ciao. Welcome to another episode of helping you build wealth through real estate brick by brick. I'm Nico James-Bock, the founder of the CondoWiz Group and broker in Toronto, GTA. Today, we aren't just looking at numbers. We're looking at leverage. While the headlines are screaming about Middle East oil shocks and static labor markets, the real story for those of you looking to enter or move up in the GTA is the substantial negotiating power currently sitting in your hands. In this episode, you're going to learn exactly how the 7.4% price dip affects your bottom line, why the supply drought is a ticking clock for buyers, and the specific mortgage strategy you need to deploy before the sub 4% rates vanish for good. Let's dive in. The mortgage moment. We're seeing a significant shift in the lending landscape. The Middle East oil shock has emerged as the biggest inflation risk since COVID-19, and the bond markets are reacting. Fixed mortgage rates are jumping. Right now, Butler Mortgage and RateBuzz are still hovering near the 4% mark for insured mortgages. But that window is closing fast. Any lender with sub 4% rates will likely pull those off their sites by the end of the week or early next week. If you're looking at the spread, 3-year rates are currently about 10 basis points cheaper than 5-year rates. But here is the deep insight. If your household budget is tight and your risk tolerance is low, do not chase the lowest decimal point. The 5-year rate, sitting around 4.39% compared to the bank's 4.56%, is your safety net. With the oil shock threatening to keep inflation higher for longer, locking in certainty for 5 years is a wealth preservation move, especially since financing beyond the 5-year mark is where the real stability lies in a volatile market. Here's the TREB snapshot. Let's talk about the March numbers from TREB. We saw over 5,000 homes sold, which is a modest year-over-year increase of 1.7%. On the surface, it looks like a typical spring market, but look closer. The MLS Home Price Index composite benchmark is down a staggering 7.4% compared to last year. The average selling price has settled at roughly $1,017,796. This is what the Financial Post calls substantial negotiating power. In a market where prices have corrected by 7.4%, the psychology of the seller changes. Days on market have crept up to 31. This is no longer the offer date frenzy of 2021. You have time to do your due diligence, time to include conditions, and most importantly, room to negotiate on price. While detached home sales actually rose by 5.2%, semi-detached and townhomes are seeing double-digit declines in volume. If you are a buyer in the townhome segment, you are in the driver's seat. And this applies to most pockets in the GTHA. The listing drought. So there is a quiet warning in these stats. New listings dropped by 16.7% year over year. We only saw about 14,400 new listings come to market in March. While the current negotiating power feels great for buyers, this drop in listings raises massive concerns about the medium to long-term supply of housing in the GTA. Supply versus demand. We are effectively seeing a seller strike where homeowners are holding back, waiting for better conditions. Meanwhile, federal and provincial announcements intended to support new construction are helpful, but they won't put shovels in the ground fast enough to bridge this gap. This means that once the current inventory is absorbed, likely later this year or early next year in 2027, we could face another supply-driven price hike. The insight here? Your negotiating power exists because of temporary sentiment, not because the fundamental housing shortage has been solved. By the dip before the supply crunch returns. The economic engine. The broader economy is sending mixed signals. January GDP edged up by just 0.1%, which actually beat the forecast of zero growth. Mining, quarry, and oil extraction led the charge. However, the labor market is static. After a year of U.S. tariffs and the population shift, we are finding a stalled labor market in Ontario. The tariff impact, and they are having an impact. The manufacturing sector has been hardest hit, with over 51,000 job losses in the last 12 months. The spillover into other sectors is starting to show. Industrial capacity utilization is at 78.5%. If industries aren't producing at capacity, they aren't hiring. This is why we haven't seen a total housing boom yet. People are cautious about their job security. But remember, the strength in the service sector is keeping the unemployment rates from spiraling. We are in a period of strained growth, which historically is a prime time for savvy real estate investors to move while the general public is hesitant. The productivity paradox. Why is Canada's housing crisis also a productivity crisis? This is a crucial connection. Advanced economic growth is biased toward knowledge-intensive activities that thrive in large, dense cities like Toronto and Vancouver. However, our urban regulations, zoning restrictions, minimum lot sizes, and parking mandates make it nearly impossible for these cities to grow elastically. The cost of inelasticity. When housing supply is inelastic, so quite rigid, any positive productivity shock doesn't lead to a higher standard of living. It just gets capitalized into higher land values and real estate costs. Essentially, we are trading national prosperity for higher mortgages. Firms want workers, but workers can't afford to move to the city. This stunts our population and our output. Until we simply we have to actually simplify approvals and scale back the barriers to building. The cost of living will continue to be the primary anchor on Canadian productivity. Investing in density, meaning condominiums, high-rise condominiums, and urban centers, large urban centers, is essentially betting on the inevitable necessity of urban growth. Don Desjardins from Deloitte recently released the Spring Economic Outlook, and it confirms much of what we're seeing on the ground. The market is likely to stay soft for most of 2026. This isn't a recession, but rather a period of strained growth. One of the biggest assumptions is that CUSMA, or USMCA, review will continue and that most exports to the US will remain tariff-free, which is a major sigh of relief for the Ontario economy. Rate forecast. Deloitte expects the Bank of Canada rate to sit around 2.25% for the course of the year. We will see higher headline inflation due to energy prices, that oil shock again. The underlying domestic price pressures are relatively weak. Why? Because the weak labor market is keeping a lid on spending. You'll spend more to fill up your car, but less on almost everything else. For the real estate market, this means a stable, slow growth environment. No massive crashes, but no vertical spikes either. This flat period is the absolute best time to build your portfolio without the stress of a bidding war. To wrap it all up, we are in a unique market window. We have a 7.4% price correction, a massive 17% drop in new listings, and a mortgage environment that is becoming volatile due to global energy shocks. The summary is simple. The negotiating power you have today is a gift from a hesitant market. But with the bank rate likely stabilizing around 2.25% and a long-term supply drought coming, and it is looming, this window will not stay open forever. If you found this breakdown valuable, do me a favor. Hit the like button, leave a comment with your thoughts on the 5-year versus 3-year rate, and share this episode with one person who is sitting on the sidelines waiting for a sign. This is the sign. Let's keep building your wealth brick by brick. Ciao.